David, welcome to the show. Glad you could be here.
So glad to be with you, Dan and Corey. Followed you guys for a long time. You're doing an outstanding service for your viewers and listeners.
Well, thank you.
Thank
Yeah,
you. Happy to have you.
I don't know what to say. I'm humbled. Um, so mostly, I want you to know, David. I know you reached out to us, and I want you to know, like 95 or more percent of the people who reach out to us, I say no, because all they want to do is, promote some little mining stock or something. And I that's my knee jerk reaction. I just take one look at them, I think about it for 5 seconds, and I say no. But when Porter forwarded me an email and he said David Tice is looking for you, I thought, oh, well, I want to talk to him. We know him. He's been around for quite a while. So I guess the best place to start is, what are you up to these days?
So I'm up to quite a lot, Dan, and I should say I've been a long time Stansberry subscriber, lifetime, whatever it is that's called. Dan, I followed your work for ages. I just love the fact you're a value investor who, understands the way the world works. And you guys tend to be somewhat bearishly inclined, especially lately. So I'm really in my third career now. I have a couple side things in it. I am helping manage a bearish mutual fund, actually a bear ETF called Ranger Equity Bear. The symbol's HDGE. I'm also helping co-manage a gold equity hedge fund. But the biggest thing I've been doing is I started a film company called Paul Revere Films, and I've produced and directed an award-winning documentary that has Dennis Quaid narrating it, talking about the vulnerability of our power grid. And I believe, as a geopolitical student, that our bad guys are out to potentially take down our critical civilian infrastructure. And I'm very, very, very worried about that. And I'm converting this movie into a movement, and it's free on YouTube. It's called Grid Down, Power Up.
Yeah, I actually had a chance to look at it, and it does it does what you intended to do, which is to kind of scare the crap out of the audience into wondering, if they're ever going to be. I think at one point somebody mentioned 18 months without power, or 3 months without power, or something like that. So you achieved your goal there. But it seems like the goal is really to inspire all kinds of folks. There was a lot toward the end of the film. There were a lot of there were a few government folks in it, and the idea was, contact your legislator and make them do something about this. I have to say, I'm uncomfortable knowing that this is a problem that we think the government can fix, because they're really bad at fixing things like that. But, they built the highway system and other things. So I guess, it is what it is. And the threat is pretty massive. At one point you said, I think it was like if 9 substations go out, the whole grid or half the grid or something could be taken out. There are 55,000 substations, 9 of them go down, the whole thing goes down. That was pretty scary. I mean, you have to know which 9 though, right? It's not any 9, right?
Yeah, exactly. So that's the good thing. So,
okay.
So that was actually a quote from a 60 Minutes story that appeared about 2 years ago. And the source of that was FERC, Federal Energy Regulatory Commission. And in fact, the FERC administrator got in trouble for, pointing that out. And this was,
I bet,
in the aftermath of a substation attack that happened in Metcalfe, California, back in 2013. That fortunately we dodged a bullet, but there was, and frankly, that attack was covered up because they didn't want the American people to know about it.
Okay. Was that the sniper attack or no?
Yes, this was it was a close range attack with AR-15s, by 7 or 8 guys outside Silicon Valley.
Wow. Yeah, and I think, am I right? I whipped through the film and I was doing other things, but am I right? They had Navy SEALs and other people come in after the fact and said, yeah, it was a terrorist attack.
Exactly.
I mean, whether it was a foreign government or, we have no idea, but it was some group decided to take out that part of the grid or something for whatever reason
Exactly.
near Silicon Valley. Yeah, which is a fairly important spot in the United States.
So to your point, Dan, about I agree, getting government to fix things is, not the best answer, and we need free enterprise solutions. Frankly, the utilities ought to be doing more, but there needs to be some regulatory pressure such that the utilities, are confident that they get full reimbursement, yeah, such that they can spend money. And the utilities suffer from this pressure from consumer groups to try to keep rates down, but this is money that we have to spend. And frankly, to protect the grid, as an example, against E3 current, not to get too far into the weeds, but would only cost about $4 billion nationally.
Mm-hmm. 4 billion nationally doesn't sound like a lot of money.
Yeah.
Yeah, that was one of the things that struck me, that when you're talking about the cost of potential solutions to here, given the amount of money we're already spending, it doesn't seem like it's it would be money well spent, to actually to do this. And I want to thank you for putting out that movie too. I watched it too, and actually a couple days, I told Dan before we started here, a couple days ago, I actually bought a mobile power station myself that can connect to solar, because I have two kids now, and little kids, and I'm like, if the grid goes out or power goes out for any extended period of time, which you point out it can happen in several different ways, um, we're in trouble.
Mm-hmm.
We're not
Yeah,
only in
bad.
trouble, the most number of people, most number of American lives that we've lost in U.S. history was about 12,000 in Galveston hurricane, and we lost 2,000 in 9/11, and those are considered massive, massive tragedies. We're talking about potentially losing 250 million people, and this is not hyperbole. This came from
Right.
the congressionally mandated EMP commission. And so just think about it. If the power grid goes out for an extended period of time, you don't have Texas able to help out Louisiana, as an example. If it's nationwide, we'd have to count on France. And frankly, we would have tens of millions of people dying from starvation and water deprivation. The human being needs water every 3 days. And if our municipal water systems are out and you don't have a barrel of rainwater in your backyard, I mean, you're looking at dying fairly quickly.
Yeah. Yeah, I don't want to die fairly quickly. When I got to the end of this film, um, I thought, this is a tough problem because you mentioned free enterprise, and the utility industry is not exactly a bastion of free enterprise. And ratepayers, consumers, will like it that way. If they really had to pay for the real cost of all these upgrades that need to happen, they wouldn't like it at all. They'd be paying more, and so I think that's how we wind up here, is that the typical thing is you give a utility company a monopoly in a particular area, and then the government says you're limited to like a 12% rate of return, and that's it, and you have to get all your rate increases approved, and they can't really price to the market. They have to price to this construct. And I think we this vulnerability that you described in the film, I think it's part of that, and the general uh, state of infrastructure in the United States, which we know that the Engineer Society is always telling us we're a D. They grade us A, B, C, D, E, F, and they're always telling us we're a D, and so this has come home to roost, I believe. I believe that's a big part of the problem.
So
So not an easy solution because nobody wants to change that setup.
that's exactly right, Dan. And just to give your viewers a real quick couple data points to show this isn't science fiction, we have a four-star general, General John Hyten, who is the prior vice chairman of the Joint Chiefs of Staff. One of the threats in the film we talk about is an electromagnetic pulse attack, an EMP. And he said, this is the real deal. It would shut out lights and infrastructure across the country. And we in the Defense Department are prepared against this because we protect our command and control centers and our missile systems, but critical civilian
And
infrastructure,
satellites.
not so much. And then the other data point is
Yeah.
Senator Angus King and also current Secretary of Energy Jennifer Granholm both said our adversaries are currently already in the grid from a cyber attack standpoint with malware or Trojan horse software. And Jennifer Granholm said our adversaries could shut down our grid.
Yeah, I remember that moment. That's a scary moment. The other thing that freaked me out was when you described in the film the potential detonation of a nuclear device way high up in the atmosphere. You might not even know it went off, but then it'd send a pulse straight down that would shut down basically everything electric. That freaked me out a little bit. The thought of a nuclear device being detonated in the upper atmosphere. Let's hope nobody is really thinking about doing any of this. I have to believe if they really wanted to do something, they would go through the cyber route because it's not hot warfare, right? You basically press a button and you shut down Texas or whatever.
Our film talks about four threats, and you mentioned a couple of them. One is cyber attack. We mentioned physical attack. Third is an electromagnetic disturbance or an EMP. And then the fourth is actually coming from Mother Nature, a solar storm or a geomagnetic disturbance. Right. All those could knock out the grid potentially nationwide. And in terms of this is all fixable too. And therefore, that's why we need every listener to your program, if they would go to YouTube, watch the movie for free. It's won awards. We have Dennis Quaid narrating it. We actually end with a happy ending, but we need to get off our keister and do something about it to provide that happy ending. And then tell your friends about it. But we need to fix this.
Yeah, there is, I take a little bit of hope, maybe it might be misplaced, but of course, power generation stocks have been screaming, and the narrative is AI, and that's what the power generation companies are telling us. So we don't have any reason to believe otherwise. It hasn't filtered as much through to the utilities, but you can see some of the action there too. So if they really are making more money, maybe there's a chance that they'll invest some of it in keeping the infrastructure safe and protecting against, especially EMP. That's the scary one, right? That's the one that just seems to come from out of nowhere. And as you mentioned, could also come from Mother Nature herself, right? As happened in, what was it, 1859 or something? The so-called Carrington event, which is mentioned in the film. Which took out, at the time we didn't have much infrastructure in this way, but it took out the telegraph system, didn't it? Just like zapped it. So those things are real too. It's not just human actors. Mother Nature could do some serious damage, as we know. So it's a big serious thing. A lot of moving parts.
I listened to your great interview with Dave Collum, who's a friend of mine, and he mentioned the fact about a geomagnetic disturbance and the fact that the poles are shifting. And I hadn't even realized that. I mean, Dave's a lot smarter science guy than I am. And how our magnetic sphere had essentially protected us some from solar, but not completely. But that was going away over time with this pole shifting. So fascinating. And to dash your hopes a little bit, I don't think we can count on the utilities without one, regulatory pressure, or a Mothers Against Drunk Drivers scale movement from your listeners, because your listeners are about the smartest out there. It's just creating holy hell on their voicemails and emails by reaching out to them.
All right, folks, you heard it. The call to action.
Right. As you point out in the, I don't want to give away the whole movie, but you talk about how it's a bipartisan issue too. Like, this is actually something that everybody should be able to agree on and can agree on. It's just, I feel like it's not on, for some reason, human nature, whatever it is, it's not on the forefront of people's minds. They just can't think about it. I mean, they just can't imagine it. But when you hear about it and think about it, like the EMP, you realize we're not that far away from just you had that George Carlin quote at the beginning, from barbaric times. Like, it's it is scary to think about, but I am interested in solutions too,
Right.
which could be good for everybody. So
All right.
Yeah.
So I started out saying, what are you up to these days? Maybe I should have told our listener, all I know about our guest today is he's that guy who always ran short funds. And now what is he up to, right? So, but you're still running a short fund, HDGE. And of course, we need to talk about this because I'm short right now. Select names. I'm not. Of course, I'm not net short, and we're not net short in our extreme value newsletters. But we are starting to pick shorts again, and finding pretty good ones, I think. So that's it makes sense to short, but short funds are tough, Dave. I mean, all you have to do is like go into Bloomberg, enter the ticker symbol of any short fund, levered or not, and look at the max, since inception, and they're all down 90%, like every single one of them, right? So you got to have good timing with these things, don't you? It's a tough sell now, but it's a tough sell period, isn't it? A short fund.
So it is. So I've made a boatload of money between beginning of 99 to 08 when I sold my Prudent Bear fund. And to some of your listeners that aren't aware of my background, so I founded and managed a fund called the Prudent Bear Fund. And we actually had some gold stocks in that fund besides being 80% short. And we actually beat the inverse of the market by about 700 basis points a year in those 10 years. But I'm not running this
Awesome.
HDGE right now. I've delegated those in the trench duties to a couple of guys, one of whom used to work with me that I have a great deal of confidence in, Brad Lamensdorf and John Delvecchia. And these guys, work their butts off every day to find the best stocks to be short. And you're exactly right. On the performance side, it is so hard to be short because a lot of times the bad companies go up just as much as the good companies. Now, just in the last year, Jeremy Grantham pointed out that about 40% of the high flyer, bad companies, in the last year are down 50%. So what's happening in these market dynamics is the S&P keeps making all-time highs because of 6 or 7 stocks. But at the margin, some of these zombie companies, these companies with a lot of debt that are ridiculously priced, are starting to underperform. And so HDGE, I don't want to go into specifics, but it has actually done very well in the last year because a lot of these bad companies that were short are going down now. And even though the S&P is up, we're actually up for the year right now.
Oh, you're up year to date.
Yes.
That's fun. Wow.
Like almost double digits even. And so there's some of these.
That's really cool.
Some of these competitors out there that are, just short the S&P, and they're down the inverse of the S&P. So they're down double digits and we're almost up double digits. And so these bad companies are starting to do badly in the market. And we couldn't be more excited about our individual positioning in some of these companies where I know you're a deep fundamental analyst. I've admired your work for a long, long time. And now we're seeing, these commercial real estate, companies starting to decline. And we have a significant percentage short there, that we think are going to be home runs for us.
Yeah, that trade is starting to heat up. I notice now there's a bunch of frauds. I think there was an article in the Wall Street Journal just within the last couple of days here that said, I think it's like 5 or 6, I think it was multifamily management companies or managers pleaded guilty to fraud. And that's what happens, right? They took interest rates down to 0. Everybody went nuts. They paid too much. They levered up too much. And those circumstances, those really loose financial conditions, basically invite the fraudsters in. And here we are. Here we are. The frauds are starting to come out of the woodwork. So yeah, I think you're going to do pretty well on that trade. People think it's long in the tooth, but it's not. I disagree with that.
So you look at the market levels right now. I mean, we're selling at 29 times trailing 12. And looking back, just to refresh my memory back, people look at the 00 to 02 crash and how bad that was. And actually the market got to 33 times trailing 12 in about July 1999. But in early 2000, it was at 29 times. And here we are at 29 times. And you look at rates are going, going back to Dave Collum, he talks about the end of the 40-year credit cycle. And, rates generally are going to go up over time, in my opinion, rather than going down. And you look at this $34 trillion of debt we have, and you look at, so many excesses, and therefore we're set up for a big decline. And I know a lot of your viewers and listeners are wealthy, so you only have to get rich once. So you better protect yourself, from a big decline rather than trying to eke out another 3 or 4%.
Yeah, well, I guess you already know I agree with you there.
Yeah.
There are very few times when you should worry much about the action of the overall market. I think when basically 7 or even like top 10 S&P 500 is almost 40% of the index. It's like 37, 38% now. I think 37 something. So, highly concentrated in a few names. Cape ratio, which has done a pretty good job of calling these huge peaks, 1929, 1999, 2022, is, up in that territory, that mega bubble, hyperinflated territory, 30s, mid 30s, right? 34-ish, 35. So, we don't predict, but we got to prepare, right? The point is not that the market's going to fall in the next 10 minutes. It's just that that historically it's priced for garbage returns from this level. And John Husband from Husband Funds, he'll tell you from this level the returns are crap for the next 10 years likely, or versus T-bills or just flat out, by themselves. So yeah, it's a rough moment. Now, to be fair, guys like us say this a lot.
Yeah.
And then the market keeps going up. So, got to be fair with that, right? I've been saying it, I said it from like 2017 to 2022, and it finally came true. And 2020 as well. I'll take a little bit of credit there because we got really bearish in like January, February. And here we are again, man. It's and the interesting thing about this one is the fastest hiking cycle probably ever, and certainly in terms of basis points, right? I mean, just percentage, not basis points. Fastest hiking cycle ever. And yet we're still still climbing upstairs, still hitting these exorbitant valuations. The market still gets more concentrated. And where I'm going with this is, I just sort of had this in my head. I wanted to talk to you about it. I think one of the things that makes it really tough for guys like us to be short now is passive. It's the bid is like eternal. It's you just can't beat it down. And my one little thought is that, well, Vanguard said 1% of their clients abandoned equities in March 2020, during the COVID crash. And I thought, what if it's 2% next time? What the hell does that look like? Because that was down 34% in a month. So there is a mechanism, I think, for this thing to turn around. But until it does, the bid just seems unstoppable. Right? I mean,
Well,
it's so hard to be short.
well, let's talk about that a little bit. So we bears, and I've been bearish even longer than you, and probably more often than you, Dan. And so, but uh,
Probably, yeah.
I joke that I predicted 9 out of the last 4 bear markets, and who knows, maybe it's 13. But
Yeah.
I
Well, at least you
yeah,
admit that.
Yeah,
That's good.
right.
but
You're not a talking head who
Yeah.
conveniently forgets it all. Go ahead.
but we were right
Yeah.
in '08. I mean, we ended up calling Lehman and the GSEs, and so we made money for clients then. And then we were short between 96 to 99. When the market was up 4 straight years. But from '00 to '02, I mean, that was utter carnage. And we know Cisco didn't get back to its all-time high. I'm not even sure if it's there yet. 15, 20 years later. And the thing is, the financial system has always been able to come back from it because we have this propensity to print more and more money and take on more and more debt. But now what we have is we have, some vigilantes, trying to call our, case for the world's reserve currency and what's going on with the BRICS and 30 more countries joining. And they feel like we've incorporated the dollar's role as world's reserve currency to essentially impoverish other nations around the globe. And we've just continued to live this, super, elevated lifestyle for our citizens. But what happens if the powers that be can't bring it back this next time? And so I think we are at great risk. And you look what's going on the geopolitical front, with 2 theaters of war currently, and then potential for China and Taiwan. Yeah, I'm looking at this BRICS meeting coming up where they're coming up with a competing, currency payment system. It certainly won't be a world's reserve currency, but it's going to compete against the dollar. And I think that is, disturbing for U.S. hegemony.
Yeah. I don't worry about the dollar as much as everybody else does, because I know dollar and gold can rise together for very similar reasons, because people get terrified. And it's hard to imagine much happening to the dollar as long as, like, the euro dollar system is in place. People don't realize how huge that is. It's bigger than, in the United States. So, and I think Bank of International Settlements has ex-US dollar denominated debt. I wanted to say at 12 trillion the last time I looked at it, which was probably a year ago or something. So there's demand. There's going to be demand for dollars. And I think when financial assets fall, you'll see the demand for dollars, and we'll probably get a spike. We could get a spike in dollar and gold, in Dixie and gold. At least that's what I think is the way the system is set up now. I think that's likely. So I worry less about that. But we've all got tens and tens and tens, and globally, 100 trillion or whatever, tens and tens of trillions anyway, in these financial assets. And we know, like, the confidence can be shaken like that. And we know the volume has been falling for years, and the liquidity, as often measured, is not what it used to be, right? So it's like passive, I think, is the force that's doing, is just like squeezing us and squeezing us and squeezing us. And then when do we get this moment, and what sets it off when that passive algo, which is just, receive $1 of capital, buy $1 of equity. It's totally mindless. There's no fundamental whatsoever. Get the dollar, spend the dollar in equity, right? When does that reverse? And if it reverses, as I believe it did in March 2020, as evidenced by the Vanguard report, what the hell does that look like? Because, man, that's like, you yelled fire in a crowded theater. There's 500 people headed for one doorway that's this wide. I just, that's the thing that makes me cringe. That's the thing that has me recommending all kinds of stuff like, from T-bills to gold to, managed futures, anything that I think will perform when equities get absolutely crushed. So far I look stupid, but I don't know.
No, your listeners and readers are lucky to have you, because you're going to be right. And I get your point about gold and dollar going up at the same time, because it is hard to choose, the Japanese yen and the euro, over
yeah, the yen
over the dollar these days. And certainly I do believe gold, having broken through 2,400, it's going to be off to the races again. And therefore, that's why I think precious metals mining companies are set up, because they're at very, very low price levels compared to the bullion price. And I also worry about, frankly, the banks. If you look at the chart of unrealized losses inside the banks going back 35 years, and the fact that we have $517 billion of unrealized losses, inside bank portfolios. And you mentioned our past rate increase cycle. That's what knocked out Silicon Valley Bank. And we have a lot of banks that have underwater loans and securities that they just have not, come to Jesus with. And then you combine our commercial real estate, woes coming. There's these stories about $100 million commercial real estate towers, one in Fort Worth, one in St. Louis, that are selling for $5 million, $10 million, and they used to be valued at $100 million and $200 million. These losses are coming at the banks.
Yeah, I was commercial real estate. I was just I just heard here in Baltimore a couple of days ago, there's about now 30% of the office space is empty in downtown Baltimore. And all these deals are just starting to, these valuations are starting to come out now when deals are starting to be made a little bit more, and the haircuts to all these values. But I wanted to ask you, like, about that, like, broadly speaking, when you're looking for shorts or equities to short, how in general, what are you looking for? Because I was looking at HDGE. I looked at some of the holdings. I'm not going to say them all, but one of them is Diageo, which is the maker of Guinness, which I am Irish. It pains me a little bit that you're short Diageo and Guinness, but I have no idea about the business. I haven't done any work on it. So how do you identify shorts in generally? Like, what are a couple things you're looking for?
My team, Delvecchia and Lamensdorf, have been doing this for a long time as well, and I cannot, recite, the bear case for, Guinness. Although I found that for me to drink Guinness, I have to be like a girl and drink it with Chambord, so it's a little bit too strong for me. Yeah, so.
Yeah, I can't drink too many of them.
We're looking at companies with a lot of debt. We are looking at companies that, stratospheric, price to sales. About a third of our portfolio is involved in commercial real estate, right now. So we have a big bet there, where we have some screens looking at from a quality of earnings standpoint, where the companies are benefiting from cutting back on uh, uh, expenses like R&D and marketing expense in order to meet their earnings per share targets. So that's some work that Delvecchia and I have done a lot of work on in the past, where fundamentally based, but deterioration in the quality of earnings. And we're looking at, we tend not to short fraud stocks, but we short companies where new competition is coming in. And we are looking technically at deterioration as well. That plays a role in our selection.
David, we tend not to short fraud stocks. Is that a very specific choice, or does your process just tend not to find them?
It's really a choice. You can make a lot of money in fraud stocks, but I've managed the short side since going back like 30 years. And frankly, there's a lot of people that do very, very well in fraud stocks. But when you incorporate short squeezes and you look at, the rebates that you have to pay, and you look at how long, fraud stocks can continue, we just feel like it's a bad bet.
Sure. Yeah. I mean, I get it. There were folks who were short Enron on the way up too. So, so we're, being fundamentally, I like the idea of being short fundamentally, based on deterioration of the business. I also am really glad you mentioned the price to sales metric. Just for our listeners' benefit, I like this for screening shorts because you don't have nearly the accounting noise at the top line as you do at the bottom. Now, my one caveat to that is Howard Shillett, who wrote a really good book about, accounting shenanigans, financial shenanigans. And he says most of the fraud occurs at the top line. So I'm thinking, man, if you can get a really good short, huge price to sales ratio, and it turns out to be a fraud too, wow, So I do like that metric a lot. I'm glad that's like the one that you pointed out. Good screen there. So I also wanted to point out something, David. Like I went back and I got the sort of since the inception chart on the Ranger Fund, and I noticed in 2011, that little break there in 2011, I think the market was down just about exactly 20%, and I noticed Ranger got a 31% hit out of that. And that right as soon as I saw that, I thought, oh, I like that. I like that you can get me, better, right? You're sort of beating it's the opposite of beating the market, right? Because you're beating it's 50 basis points. If the market's 20 down, you're 30 up, but you're really sort of, there's that, I don't know if there's a metric for this because I don't know these things. I don't worry about them, but it's like the negative beta would have been, minus 20%, but you guys did 50% better than that. And I looked at that and thought, okay, there's potentially real juice in here. And now you're up year to date, like 9.2%, it looks like here on Bloomberg, just using closing prices. And I'm thinking, yeah, right? Because you're basically, you're not picking the Magnificent Seven, you're shorting all the other stuff, which is the earnings have been crap for the other 493 of the S&P 500. So I have to say your fund's too small. Like I can't ever cover it in any publication, but you're on my radar screen here, and I want to look into it more because it's got some interesting performance characteristics. And, it sounds like the guys that you put in charge are doing a good job to me.
Yeah, actually, they founded it, and they found me from my past, so I have to give them credit for founding it. But to your point about these bad companies and these high flyers with high price to sales, they definitely outperform the inverse when there's a decline. And if you look historically at most of the bear funds, and then especially the ones that are individually selecting equities, they go up a lot more, because these the bad companies. What's frustrating, in this kind of fund is a lot of the time, as I mentioned earlier, the bad companies go up as much as the good companies. But when
Yeah.
when the ship starts to hit the sand, as I say, these bad companies do much worse, and so we can outperform significantly.
Right. And I have to say, you made a good point there, because not only can the bad companies do just as well, like they can soar because since there's often no earnings and sometimes no sales, like it's all just a story, right? I mean, it's a story that and
It's people who
yeah,
like
a
Guinness.
story and
Yeah.
market structure sent the the meme stocks just major huge multi-bagger within a matter of days. And of course, the businesses are very obviously not worth tens of billions of dollars. So it would have to be a good story. And then when they fall apart, man, it's when those crappy companies go ballistic, when they fall apart, oh man, um, it's it's an excellent point. When you get the bad businesses that are going up as much as the good ones, it hurts to be short, right? But then on the other side of it, that's where you get that amazing, better than inverse performance that you guys have enjoyed at least, more than once, it looks like here. So,
And
yeah.
as Buffett says, when the tide goes out, we find out who's swimming naked, right?
Yeah, you're looking for the naked swimmers. I think that's the way to do it. But I did notice on the website, on the Advisor Shares page for you guys, there is a technical input to it. Like it's
Yes.
not all fundamental. I know you've outsourced the management of this thing, but can you speak to that a little bit at all, or
Yes. Uh, so we've got a very sophisticated, quantitative screen, that
right?
we've worked on for a number of years, and we're definitely looking for, starting some underperformance of these equities. So we don't want to, short, the antithesis of the falling safe or the rocket ship on the way up. We want to see some kind of breakdown first, and there's a number of other components to that.
Okay, gotcha. The current, do you know Scott Fearon? Do you
I
know him?
do. It's been a number of years, but I remember him briefly. I should get back in touch.
Yeah, I want to get back in touch too, because uh, my partner in crime, Mike Barrett, and I in the Extreme Value newsletter have kind of adopted Dead Companies Walking, his excellent must-read book on short selling. If you're into shorting, or even if you're not, if you just want to know what a guy who's good at spotting bad companies thinks like, and you should read that book, Dead Companies Walking. But um, he's like, I don't even want to short until the thing is down 50%. That's when you see like investors are abandoning, and then you look at all the fundamentals that are deteriorating, and a lot of the times those are the ones where it's like, how's this thing ever going to turn around? um, I don't know, I just wanted to call that to the listeners' attention, because you reminded me of it. uh, so
That's interesting, Dan. That reminds me of remember Hari Krishnan
yeah.
that we had on wrote the book on the second
Yep.
leg down. That was more broad market
Yeah,
based,
no,
but I guess the same idea could be applied to individual
absolutely.
stocks, right?
Similar idea there, right? You've seen the leg down, you've gotten the
Yep.
recovery, and now wham, let's hit them with the second one. So, but David, though, we need to cover the third thing you mentioned was a gold stock hedge fund. When I asked you what you're up to nowadays.
Yes. So uh, we're really excited about mining companies, and
Mm-hmm.
with gold and silver, I like silver even more than gold. And I have a partner that's been managing day-to-day equities on the gold stock side for a couple decades, with really great performance. And we believe that these mid-cap producers, are still selling extraordinarily cheaply today. And, a number of companies selling at soon to be single digit PEs. And I believe the price of gold, is going to go up a lot. The fact I'm a believer that there's been some gold suppression in the past, keeping gold below $2,000 for a long period of time. We ended up, breaking through 2,400. People like Jim Rickards have price targets as high as 24,000 or so for the gold price. We don't have to get to anywhere near that. If we break through even 2,800, these mining companies are going to be, printing money in terms of profitability. And then what happens, big fan of Rick Rule, who has this conference going on right now in Boca Raton, about how when gold price goes up, then with operating leverage, their earnings go up dramatically, and then exposure to those gold stocks by institutions and individuals goes through the roof. And that creates really a decade of gold stock outperformance. And so we saw that in the 30s, the 70s, the 00s, and we feel like in this mid 20s period, we're likely to see between 500 and 1,500% returns, which has been typical, and it could be even greater than that in terms of with gold price going up above 3,000. And you look at the fact that we have the BRICS making increasing in size by 20 to 40 countries, and then suddenly they're not going to have to be trading in dollars all the time. And I think there will be some kind of gold backing for some kind of currency system. And like you say, the dollar is not going to go away, but gold's going to do well. And you look at the geopolitical pressures in terms of, I'm nervous as hell about where we are with NATO. Seems to be baiting the bear a bit, with Russia. And you look at this Hamas, Hezbollah, Iran situation, and I think we're as close to World War III as we've been in a long time. I mean, you look at Cuban Missile Crisis, and it looks a lot scarier than that. And therefore, gold's going to do very, very well.
Yeah, those boy. We got into we don't want to get into that NATO situation because it really pisses me off because nobody really understands what's happening over there. But maybe we'll have you back and talk about that another time. But for now, I just wanted to ask you. I'm going to be at Rick's event. I'm leaving tomorrow, I may as well tell folks we're doing this interview on the 9th, and I'll be there the 10th and the 11th at Rick's event. And so I'm going to talk with Benoit LaSalle. I'm going to be on stage a couple times, and one time I'll be talking with him from Aya Gold and Silver. You guys don't happen to own Aya, do you?
I do not.
Okay, just taking a shot in the dark there. Rick has apparently invested with him for like 20 years or whatever. But now that we got that out of the way, is there a name that you feel like you can talk about? I know you don't want to give away your secret sauce. You're running a fund. It's for your clients. But is there a name that you would feel comfortable talking about, or no? If it's no, it's cool. It's fine.
We actually like Liberty Gold, and
Liberty Gold.
We still like Newmont a lot, even though it's the big boy, relative to, and we tend to shy away from the biggest companies, but we feel like Newmont is incredibly cheap today. And we know once gold gets started, the big boys are going to go for the big boys.
Right. And Liberty Gold, what's that, like a small cap?
This is a smart cap. It's run by a good friend of mine with a great amount of expertise in the business. Can't recite any more details in that, but we feel like it's extraordinarily undervalued.
Oh, okay. All right. Yeah, let's see here. I've got about a 96 million US market cap. So, I mean, not tiny actually on small cap, gold standards, like not tiny. Some of them are single digits, 10 million, 20 million, whatever. So, um, and there's for a little gold stock, there's a decent amount of liquidity to it. So,
Yeah.
I won't be recommending it anytime soon, but certainly could be interesting.
Yeah.
So,
All right. So gold, David. Just one thing I want to make sure I ask you before we wrap up. So, given the geopolitical concerns, the susceptibility of the power grid, where stocks are valued today, like how are you? You've been in finance, for your whole adult life. Like how are you protecting yourself, your family, your wealth right now? Like what's your blueprint?
So I own gold stocks. I'm actually a buyer of out of the money gold stock options expiring in early 25. I feel like there's a great opportunity there for, doubling of gold stocks fairly quickly. So I think that's a great risk reward bet. I'm a believer in longer term treasuries because I think that we could get into a deflationary scare. I'm definitely nervous about inflation, but I feel like, owning some longer term treasuries as part of a barbell approach makes some sense. Uh, I'm a believer in, I'm worried about the banks, frankly, and I'm worried about this situation with the FDIC has about $100 billion in reserve. That's 0.6% of all uh, deposits. But what we have is this massive commercial real estate, debacle coming. We have, $500 billion of uh, unrealized losses on bank balance sheets, which is, the biggest number going back 40 years has been, I think, $10 billion. I mean, we've never seen anything like that. And therefore, I think it makes sense. Then you throw in the potential for bail ins. So I'd say your viewers ought to go to YouTube and listen to some other people out there about what Dodd-Frank did in terms of bailouts, and even this recent Supreme Court ruling for Chevron that essentially makes it tougher for there to be bailouts. And therefore, you ought to be concerned about the potential for bail-ins. And therefore, I'm a believer in having some money directly with gold that you can potentially spend. And there's vehicles out there, that will allow you to do that.
all right. So, David, I'm going to ask you to that was a nice summing up, and I'm going to ask you to concentrate your summation one level deeper
Sure.
by asking my final question, which is the same final question for every guest, no matter what the topic, financial, non-financial, same question. And it's very simply, also, if you've already said the answer, by all means, feel free to repeat it. It's a simple question, though. If you could leave our listener with a single thought today, what would you like it to be?
All right. I've been ready for this because I listened
Oh,
to your past programs.
Yeah, he lives.
And
Yeah.
so I say people do consider me David Dyer at times because I tend, as I say, have predicted 9 out of the last 4 bear markets. But I truly believe this is an extraordinary moment in time. And in terms of where we are with massive debts, you look at who we have in office in terms of Biden was likely to happen in front of this election. You look at the fact that we have the potential for bail-ins. You look at the fact that we're at 2 theaters of war that I mentioned before, and the potential for China and Taiwan. I think this is a time to be scared. And so I listened to Dave Collum, and he said, if you're younger, you can't really think too much about it, but I think now's the time to be nervous. And I'd say, get out of the market, at least to a bigger degree, have some gold, think about personal safety, have some extra food in your pantry, and think about a bug out location if the ship really hits the sand, because population density is not your friend if it gets really bad. And you throw in the fact that we have, tens of thousands of sleeper cells in our country right now from our porous borders, it's time to be nervous.
Okay, a dire warning from David Dyer. Of course, how dire can a guy be with like 4 granddaughters, right? I mean, come on.
I'm so happy about that, and
Yeah.
I'm truly blessed.
Yeah. Listen, David, I knew it would be a pleasure to talk with you again. It's been way too long. Let's not wait so long next time, all right?
Look forward to it, Dan. Keep up the great work. Your readers and viewers, listeners are truly blessed.
Well, thank you.
Great
Good to
having
be
you on.
with you too, Corey.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.